Would you like to be a shareholder in one of the world's very best businesses? Like the idea of collecting a market-beating dividend from a company that's been increasing its dividend for almost 50 consecutive years? Want to invest in a business that's profitably catering to one of society's most basic and necessary needs? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. I want to tell you about a high-quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business owns quick service restaurants all over the world that are serving millions of customers every single day. People have to eat. It's a basic and necessary need. Well, this company provides food, a lot of food, and they do so in a unique and profitable manner that puts them really in a league of their own. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of McDonald's Corp, which appear to be trading at a significant discount today. McDonald's Corp, stock ticker MCD, is a quick service restaurant chain that operates worldwide. Founded in 1940, McDonald's is now a $159 billion by market cap global fast food leader that employs over 200,000 people. By many measures, McDonald's is the largest fast food chain operator in the entire world. Across almost 40,000 system-wide restaurants, they purvey their burgers, sandwiches, and beverages to millions of customers every single day. Fiscal year 2019 revenue is split across 3 global business segments. International operated markets, 54%, US, 37%, international developmental licensed markets and corporate, 9%. There's almost nobody in the world that isn't familiar with McDonald's. This is one of the most well-known brands on the planet. People have to eat, and investing in that theme seems like a pretty straightforward concept. Well, investing in the world's largest provider of fast food is a common idea that has yielded uncommon profits. That's because McDonald's is special. They're expert at providing a global customer base with quality food at a great value at a very high level of consistency and speed. Consumers know exactly what they're going to get when they patronize a local McDonald's restaurant. Perfecting a mixture of quality, value, consistency, and speed has turned McDonald's into a venerable business that has done extremely well for decades. But it gets even better. The company operates mostly through a franchise system. Franchisees run local McDonald's restaurants. These franchise arrangements often include a lease and a license, which provide the company McDonald's payment of initial fees, as well as continuing rent and royalties. This is an attractive business model. McDonald's is essentially one of the world's largest landlords, with a steady stream of restaurant royalties underpinning all of that. It's a 1-2 punch that almost cannot lose, and this rent royalty combo built on the foundation of the world's largest fast food chain bodes well for the future. Shareholders should expect profit and dividends to continue to flow and grow for decades to come. As it sits, McDonald's has increased its dividend for 45 consecutive years. That puts them in rarefied company, especially in the hyper-competitive restaurant space. The 10-year dividend growth rate is 8.4%. That's paired with the stock's current yield of 2.5%. While this is right in line with the stock's own 5-year average yield of 2.5%, the important consideration here is that it's a market-beating dividend from one of the world's best businesses. The dividend payout ratio of 78.8% is a bit high, which will likely moderate future dividend growth, but it's secure income for shareholders. Keep in mind too that this payout ratio is based on trailing 12 months earnings per share, which has been affected by the pandemic. This ratio will likely lower once the business normalizes. I tend to consider a yield of between 2.5% and 3.5% paired with a high single-digit dividend growth rate to be the sweet spot for dividend growth investors. The stock is right there. Looking at business growth, McDonald's has seen its revenue decrease from $24.074 billion in fiscal year 2010 to $21.077 billion in fiscal year 2019. A decrease in revenue is not what I like to see. However, this is due to a change in the business model. McDonald's started a refranchising plan years ago that saw a lot of company-operated stores move to the franchise model. This short-term disruption to revenue comes at the long-term benefit of a more stable fee-based business with higher margins and less company overhead. Meanwhile, earnings per share moved from $4.58 to $7.88 over this period, which is a compound annual growth rate of 6.21%. Very solid bottom line growth here, particularly when considering the sheer size of the company. The aforementioned margin expansion has helped, and a rather substantial buyback program has definitely propelled some of this excess bottom line growth. For perspective on that, the outstanding share count is down by approximately 29% over the last decade. Looking forward, CFRA is anticipating that McDonald's will compound its earnings per share at an annual rate of 7% over the next 3 years. That would be pretty close to what McDonald's has put up over the last 10 years. While the business has suffered from COVID-19, CFRA sees a very sharp rebound in store. Here's what they have to say about the near term, and I quote, "With plans to open another 1,300 restaurants in 2021, mainly in the US and China, and further recovery in comparable sales, we expect a rebound to nearly 14% revenue growth in 2021, unquote. In addition, the pandemic has given the company latitude to experiment with and expand its service channels. In particular, the company will surely benefit over the long run from an expansion in delivery services. I suspect a quick return to the status quo or better is very much in the cards for McDonald's. After all, the groundwork around refranchising has already been laid. Indeed, one could argue that bottom line growth will accelerate coming out of the pandemic. Either way, we're looking at high single-digit dividend growth for the foreseeable future. Again, this is the sweet spot. Moving over to the balance sheet, this is the only area of the business that somewhat troubles me. The company used to have an amazing balance sheet, but they've taken on debt in recent years, partially in order to fund buybacks. There is no long-term debt to equity ratio here. Common equity is negative due to the high amount of treasury stock from those buybacks, but a long-term debt load of over $34 billion is quite a bit higher than it was only a few years ago. On the other hand, the interest coverage ratio of a little bit over 8 for fiscal year 2019 indicates no issues with the interest costs. Their long-term debt commands investment grade ratings from both Standard & Poor's, BBB+, and Moody's, Baa1. Profitability is a bright spot in my view. Margins have expanded nicely of late. Over the last 5 years, the firm has averaged annual net margin of 23.75%. Negative common equity has made return on equity not applicable. McDonald's is a world-class business that is really in a league of its own, and with global scale, unrivaled brand recognition, pricing power, and a unique position in the marketplace, the company does benefit from considerable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. In particular, the fast food arena is hyper-competitive. Being a global business, McDonald's is exposed to currency exchange rates. The company's size does in some ways work against them. It's a mature business, which can limit growth. The long-term impacts from COVID-19 on quick service restaurants are still unknown, and input costs like meat can be highly variable. Even after being made aware of these risks, I still believe this is a compelling long-term investment idea. And with the valuation being where it's at, the stock is made to be even more compelling. The stock is trading hands for a price-to-earnings ratio of 31.6. At first glance, that's high. However, this is based on trailing 12 months GAAP earnings per share. Like a lot of other businesses, McDonald's has been negatively impacted by the pandemic. The question is whether or not this is a permanent hit to earnings. I suspect it is not. Likewise, the price-to-cash flow ratio of 25.2 looks a tad rich relative to its 3-year average of 22.2. Once earnings and cash flow rebound to normal levels, I think the stock will look cheap. Of course, the stock's price could and perhaps will take off in anticipation of that normalization, leaving this current opportunity in the dust. Notably, the stock's yield, as noted earlier, is right in line with its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7.5%. This dividend growth rate is on the high end of what I ordinarily allow for. If there's any business in the world that deserves the benefit of the doubt, it's this one. I'm basically splitting the difference between the demonstrated 10-year dividend growth rate and what the business has done in terms of bottom line growth over the last decade. My 7.5% dividend discount model analysis dividend growth rate is right in the middle. I think it's also worth pointing out that this is fairly close to CFRA's near-term earnings per share growth projection, which could actually prove to be conservative. The dividend discount model analysis gives me a fair value of $221.88. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it could provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates McDonald's as a 4-star stock with a fair value estimate of $236. CFRA rates McDonald's as a 4-star buy with a 12-month target price of $250. I came out a bit low. Averaging the 3 numbers out gives us a final valuation of $235.96, which would indicate the stock is possibly 14% undervalued. Here's the bottom line, guys. McDonald's Corp is a high-quality company with unrivaled scale and brand recognition. It's a classic blue chip stock that I regard as a must-own for long-term dividend growth investors. With a market-beating dividend, inflation-beating growth, almost 50 consecutive years of dividend raises, and the potential that shares are 14% undervalued, this could be your opportunity to invest in one of the very best businesses you'll ever find. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.